Okay, guys, it's Mr. Frankham here. Um, Real quick, two people, Cassidy Hardy and Maggie Moser, both got the last song right, Paradise City, for their free stock. Cassidy Hardy is crushing it. She's gotten every single one right. She's the only person to do that. So today we're going to do a new quick song, and then we're going to have a little discussion on mutual funds, index funds, and ETFs. We've talked about stocks, and you understand what stocks are now, I think, at least if you did the assignments, you should. Now we're going to take it a step further and talk about another investing option, which would be ETFs, ETFs, mutual funds, and index funds. Before we do that, let's do a new song for this week for a free stock. The first 10 people to reply. Okay, I'll be honest with you, this is a song that I was not familiar with. It's not one of my normal songs that I listen to. This came out in 1994. All right, there you go. 1994. I know some of your parents graduated from high school in the 90s, so they might be able to help you with that. Again, it's not one of my typical songs that I listen to, but I'm trying to be diverse and give everybody the opportunity for a more diverse set of songs. Okay. All right. Now, I apologize. The hair. Need to get my hair cut. Starting to grow wings here. Look at that. Pretty soon I'm going to fly away. All right. Okay. Let's jump in and talk about exchange traded funds, mutual funds, and ETFs. So, quick question. So, people would say, now we learned about what individual stocks are. When you buy a stock, you actually become a part owner of the company. Okay, you are literally an owner, even though it's a teeny tiny percentage of a company. Well, there's an important term in investing that we talk about a lot. It's called diversification. That means you're spreading your investment out. You're not putting your eggs into one basket, so to speak. So if you buy one stock, just let's take General Motors, for example. If you own General Motors in 2008, General Motors is the parent company of Chevy and Cadillac and brands like that. If you owned General Motors in 2008, you lost all your money because they went bankrupt. And so when they filed for bankruptcy, any investors basically lost everything. So how can you protect yourself against, well, I will also say this, companies don't go out of business overnight. So there are major indicators that show you how well a company is doing. And those are the things we talked about already. Things like the debt to equity ratio, the earnings per share. Those are critical things. If those things start to decline or start to look bad over time, then the company's not in good financial health. So, but let's say you don't want to take the time to really dig in and learn everything, all the finances of the company you want to invest in. You want somebody else to do it for you, and you want to have it less risky, so that maybe it's more diversified. It's spread out across a lot of different investments, so that if one stock starts to go bad, it won't hurt you as much because you'll have others that can keep you afloat. So one way to do that, probably the best way to do that, is through an investment tool called a mutual fund. Okay, there's a mutual fund. There's also another thing called an index fund. And there's also something called an exchange traded fund. which sometimes that's abbreviated to an ETF. So you have mutual funds, index funds, and ETFs. I'm not going to bore you with the details on the differences between the three, other than to say that mutual funds are what we'd call actively managed. So you have somebody that is constantly, every day, taking stocks out, putting new stocks into the fund, trying to beat the market. So if the market goes up 10%, they're trying to go higher than 10%. An index fund, however, is intended just to track the market. It's not trying to beat the market. It's just intended to do whatever the market does. And so these are what we call passively managed. So you have, they might not do it every day. They might not take stocks out every day. Maybe they just do a few here, a few there, and they, whatever the index. So, well, maybe explain what indexes are. If you watch the news or you listen to the news, sometimes you hear what's called the S&P 500 or the NASDAQ or the Dow. Okay, those are all indexes or indices. And the indexes basically track a certain portion of the market. So if you hear about the S&P 500, the S&P 500 index, that tracks the 500 largest companies in the United States. And so if you buy an index fund, that would mirror the S&P, or so if you buy an index fund, you can buy an index fund that mirrors the S&P 500. So that means if you buy that, you're automatically invested in the top 500 companies or the 500 largest companies in America. All right, so let me maybe try to further illustrate this, give you some actual. Okay, I think you can see this screen now. Okay, so I just went to Vanguard.com. This is just one example of a company who creates index funds. And so there's many like it. You could, there's Fidelity, there's T. Rowe Price, there's all kinds of things. So, but this is just one example. I'm using this one because this is the one I'm most familiar with. Okay, but I'm going to go up here to investing, and I'm going to click on Vanguard Mutual Funds. Okay, a mutual fund basically is just a basket of stocks. It's like having a whole bunch of stocks all at once. Okay, so I'm going to just click on, let me just look at, let me go to Vanguard ETFs. This is exchange traded funds. It's like a mutual fund. Well, it basically is a mutual fund, but it trades like a stock. Don't get bogged down on the differences between the two. But let me show you some specific examples of an ETF. Okay, we talked about the Vanguard or the S&P 500. So Vanguard created an index fund that mirrors the S&P 500 index. Okay, so if you're invested in this, and this is actually the actual fund that my wife owns. So if you hear on the news that the S&P 500 went up 10 points, that means my wife made money. Anybody invested in the S&P index, that means they had made money that day. Or if the S&P goes down, that means they lost money that day. Okay, so a couple things here to note. It says, it has a ticker symbol, and that's VOO. Again, you can purchase these on the MarketWatch simulation if you would like to. Okay, the expense ratio right here, if everybody can see that, is a 0.03%. Now, this is probably the biggest difference between index funds and mutual funds. Okay, index funds are passively managed, which means the fund manager doesn't mess with it every day. They only change things as the index changes. So the expense ratio, this is what the fund manager makes. He or she would make 0.03% from managing this fund. Now, if this were an actively managed mutual fund, that would be 2, 3, maybe even 4%. So this is a fraction of a percent, way less than 1%. And actively managed mutual funds would be making more than 1%, way more than this. So like I said, 2, 3, 4%. Okay, now the interesting thing is you'd think because the mutual funds are actively managed and they're trying to beat the market, you'd think that they would actually produce better returns. But over the last 20, 25 years, it's actually been shown that 80% of actively managed mutual funds do not beat the market. And so you're 20% do, 80% don't. So index funds, and this is one of the things Warren Buffett really strongly recommends for people who are not that interested in evaluating stocks themselves, which, like I said, this is for like 95% of the population. Index funds or ETFs are probably the best investment tool you can use. Okay, so let's look at some other things here. Risk potential, there's a correlation between risk and reward. If you put your money into a savings account, there is no risk in that. Your money is going to be there. And you think, well, what if the bank crashes? Or what if the bank goes out of business? Well, you still have, because of the FDIC, or if it's a credit union, the NCUA, they're agencies that insure your money in either a bank account or a credit union account. And so if you have less than $250,000 in your bank account and the bank goes under, and the NCUA or the FDIC will give you your money back. So your money is insured. Okay, but so there is very little risk in putting your money into a savings account. But remember the correlation between risk and reward. If there's no risk, you are not going to make any money. If there's a little more risk, then you could potentially earn more money, but you could also potentially lose money. Okay, so keep that in mind. There is a correlation between risk and reward. And in my opinion, where especially you guys are so young, you can afford the risk because you have 20, 30, 40 years to invest. You know, if somebody, because remember, we talked about this before, people lose money in the stock market. In fact, let me try to illustrate this here. I don't know if you guys can see this graph here. People lose money in the stock market because they sell at the wrong time or they buy at the wrong time. So for example, I don't know if you can see this little chart here. Okay, maybe let me try to zoom in on it. Okay, so let's say you're going along here in 2016 and the market starts going really good and people are like, oh man, the market's going great. I better get in on this. I better buy. So they buy in 2017, they buy right here. Okay, the market keeps going up for a little while and then the market starts to go down and people freak out and they say, oh no, I better sell before I lose all my money. And so they buy right here and then they sell right here. Okay, that is the most common way that people lose money in the stock market. Occasionally people will lose money because the company they invested in goes out of business, but that wouldn't be an issue if you invested in a mutual fund or an index fund or an ETF. Okay, by far the most common way people lose money in the stock market is they buy when the prices are high and they sell when the prices are low. And so the market goes down, they think, oh no, I better sell because I better cut my losses and save whatever money I can. Well, they sell here and then look what happens. It comes back again. Okay, and then it drops again and then it comes back. So you can see over time the market fluctuates. And if you could zoom in on any one of these cycles, you know, you can see that it will go up and then down, up and down. But if you average it out, it's very positive. So if, in fact, this is the hypothetical growth of the last 10 years, and this includes the current recession that we're in right here. Okay, so if you would have invested in 2010, $10,000 in the S&P 500 index, now you'd have $28,000. Okay, that's $18,000, and that's assuming you didn't add any more money to it. That's just assuming you put the money in there, left it, And actually, a couple months ago, it would have been $35,000. Okay, so that's the power of compounding interest. That's one of the best ways. Remember, the richest man in Babylon talked about making your gold work for you. Make your money work for you. Don't let your money be lazy. So if you invest it, that's $18,000 that you would have made by doing absolutely nothing. All you had to do was put the money in. Now imagine if you continue, especially right now. In fact, I had a former student from last year email me and say, the market just went down. Should I invest? And I said, yes. Now's the great time to invest, because you have to think about it. The psychology of investing is very strange, because in no other circumstance would people want to buy when the prices are high and sell when the prices drop. Like, think about, like, in housing. When the housing market goes up, it's a seller's market. Everybody's, oh man, that would be a great time to sell my house. When the housing market drops, nobody runs out to try to sell their house, because if your house is worth $300,000 and then, within a month the value of it drops to $200,000, nobody rushes out trying to sell their house, because as long as you hang on to it, the value of your house will come back. At least historically it has. But for some reason with stocks, people think differently. They think, if the price drops, I better hurry and sell it. Maybe it's because it's not as tangible as what a house is. But you have to resist that urge. You have to think of it the same way you would think of buying a sweater. Let's say you found a sweater that you really, really love, and it's $50. Well, if you're willing to pay $50 for your sweater, and then a couple days later, the store's going out of business, and so they drop the price of the sweater down to $20. Do you not like the sweater anymore? Or does this mean it's not a good sweater for you to own? You liked it at $50. You should like it that much more at $20. So that's what's happening right now, is because of the recession, and it's a hard time because a lot of people are struggling for money financially. So a lot of people don't have extra money to be able to invest. But sometimes there's these type of market declines that aren't necessarily related to something major, like obviously this pandemic. But if the price drops, the worst thing you can do is sell. Okay, that's how most people make their money. Okay. All right. Let's go back and talk about. Let me zoom out again here. I should say that's how most people lose their money. I think I said backwards. Okay, so we talked about diversification. Well, let me just point out this one little chart here. Over the last 10 years, the S&P, or since this since the fund started, the S&P 500 index is up 10%. Okay, since September of 2010, this particular fund, this index fund, has averaged 11.69% growth. Okay, and you can use the rule of 72 to figure out what that effect that's going to have on your money. Okay, if we come down here a little further, this tells you what types of businesses are in the S&P 500 index fund. So you have communication, consumer discretionary, and we don't need to get bogged down into those, but different things, like different companies fall into different categories. So for example, healthcare, this could be things like pharmaceutical companies, or even hospital, like Intermountain Healthcare. I'm not sure if they're publicly traded, but if they are, they would fall under that. Information technology, this would be things like computers, Microsoft. Utility companies, things like Rocky Mountain Power. So companies fall into different, or financials is an easy one, like banks, Wells Fargo, Chase, JP Morgan Chase, Bank of America. They would be considered in the financials sector. Okay, so this is the breakdown of what companies are in the S&P 500. By far the biggest is the information technology. things like Apple, Microsoft. Okay, all right. Remember, I talked about this. This is kind of cool because you could either put your money into one stock, but that's a little risky because it's not diversified. Remember, diversification is important. So if you look right here, the S&P 500 index fund has 508 different stocks. So I could buy a share of this and automatically be invested into 508 different companies. Okay, and here are the 10 biggest companies that it has. Remember, it has 508, but 24% of it is in Microsoft, Apple, Alphabet, which is Google, Amazon, Facebook, Berkshire Hathaway, which is Warren Buffett's company, Johnson & Johnson. They make pharmaceuticals, also shampoo and stuff like that. JP Morgan, that's a bank. Visa, credit card company, have you heard of that? Procter & Gamble, this is one you probably have not heard of, but I'd be willing to bet that almost every single one of you have used a Procter & Gamble product today. In fact, just go online and search it up, or even look at the back of your toothpaste and see what company makes your toothpaste or your deodorant, things like that. So you're probably more familiar with Procter & Gamble than you realize. Okay, those are the top 10 largest companies in the S&P. Okay, all right, so this is a good option for you if you're like, oh, I'm looking at a bunch of stocks. I don't know what to do. I don't know what to buy. You can just buy an index fund. Okay, let me show you some other cool stuff here. Now that you're kind of familiar with what some of these terms mean, you have the price to earnings ratio, where we looked at the PE ratio for individual companies. Well, now you can see in the S&P 500 ETF, the average PE ratio for all 508 companies is a 19.7. The average price to book ratio is a 3.1. The earnings growth rate, or the EPS growth rate, is a 12.2. So you can see, apply the information that you've learned on some of those other things. Okay, again, I'm just at Vanguard.com. Okay, let's look at one other index fund. This is one I actually own myself. This is called Vanguard's Mega Cap Growth ETF. This is an exchange traded fund. It's basically an index fund that tracks large companies that have a lot of growth potential. So same thing, you can see the risk potential down here. You can see over the last 10 years, zoom in here. Over the last 10 years, it has grown at an average of 12.81% per year. Okay, you can see the hypothetical growth. A $10,000 investment would now be worth $33,000. Okay, that is $23,000 that you had nothing, you didn't have to do anything to earn. Okay, so again, making your goal, making your money work for you. Okay, you can see this one only has 112 different stocks in it, so it's not as diversified. Remember that diversification is an important thing. But again, part of the, because it has less companies, that makes it a little more risky. And you have to understand time is a major variable in how much risk you can afford. The market's going to fluctuate. You can see in this chart here, it's going to go up and down. It's going to go up and down over time. So if you're 65 years old and getting ready to retire, then you don't want as much risk because maybe you need to live on this money. You can't afford a big market drop like we've had the last couple months. So at that point, you would probably not want to be in stocks as much. But right now, where you're young and you have a lot of time for your money to grow, I would start a couple things with investing in the stock market. If you need the money within the next 6 months, year, 2 years, the stock market is not a good place to put it. It's not a good place for a short-term savings. If you invest in the stock market, now I'll let you, some people might say, well, what about day traders? Day traders do, and now some people do make money off of day trading. I've never done day trading. That doesn't interest me. Some people do well with it. I'm not telling you you should or you shouldn't. but that doesn't. I would suggest that before you jump into it, you do a little more research on day trading, because it's just a little too volatile for me. When I invest in the stock market, I intend to leave the money there for a long period of time. That's just my investment mentality. So I'm not looking to buy a stock in the morning and sell it in the afternoon. I think if you invest in the stock market, you need to have a long-term outlook. Like, you need to be thinking in terms of decades, not days. All right. So if you need money now, if you need money within the next year, the stock market's not the place to put it, because the market could decline within that year, and the value of the asset could really diminish. But if you can afford to leave it there, then it can come back. Okay, so just keep that in mind. So you can see the top 10 in this particular fund has Adobe in there. So mostly a lot of IT companies or software companies. Okay, let me zoom out again here. All right. So I'm going to, again, click on the same information that we clicked on with the S&P. Remember, the PE ratio is like a 19 for the S&P 500 index. This is a little higher, and you'll find that with growth stocks. The PE ratio is a little bit higher. The price to book also would be a little bit higher, but the EPS growth rate is at 17.6, which is really good. So it depends on what you're looking for, but it's more risky than the S&P, because there's fewer companies, and these are companies that meet a specific criteria for growth. So there's a lot of them. If you don't want to buy individual stocks, you can just, like I said, for 95% of the population, an index fund or an ETF would be the best thing to do. Okay. Now, what else was I going to show you with this? Yeah, that's pretty much it, I think. We'll talk more about this later. This is just some information I wanted you to get out. You will have questions. You will have to understand what diversification is and why diversification is important for you, and understand the difference between investing in an individual stock versus investing in a mutual fund or an index fund. So hopefully that made sense to you. Basically, you're just investing in a whole bunch of different stocks all at one time. So yeah, let me click back to the regular screen. Okay. All right. So I want to make sure everybody watches this video. There's no assignment associated with this video. Although I want to make sure everybody does it. So yeah, I think I'm going to add just one thing. I want you to find, aside from the ones I've shown you, I want you to find and recommend an index fund or an ETF, and why you think it would be a good choice. Talk to me about the diversification. Talk to me about why it would be a good investment for people. Okay, how many different companies are in there? What's the growth rate of the fund? Things like that. You just have to find one. Okay, but it can't be either of the two I showed you. It cannot be the ticker VOO or the ticker MGK. Okay. Again, it's not. I'm not trying to overload you with busy work, but I want to make sure you're actually doing something associated with this. So to really benefit you, I really think this is. Oh, one thing I was going to mention too. When should you start investing? My advice on that would be when you start working full time. So if you're going to go right out of high school, right into the job market, and become a member of the workforce, I would start investing then. If you're going to go to college and work on a degree, you probably won't be able to afford investing as a college student. You'll probably have to spend all your money on tuition or housing or whatever the case may be. So my advice would be, at whatever point you start working full time, take about 10% of your income and invest it. Whether that's, right out of high school or after college, as soon as you become a full-time worker, start investing. Okay, let me know if you have any questions, and we'll talk to you later.